For more on China's stock market, I spoke with Jennifer Carpenter. She's a professor of finance at New York University's Business School and a co-author of a study titled The Real Value of China's Stock Market. I asked her about the importance of Chinese stock market to the overall global economy.
Well, now that China's become the world's largest investor, investing more than twice as much as the U.S. Last year in real terms, so it's really the largest investor by a wide margin. The efficiency of China's investment is a matter of global concern, and China's financial system will largely determine the efficiency of that investment because it's the financial system that decides which projects get financed. And China's financial system has been dominated by its banking sector, while the stock market's been a bit of a sideshow. But what our research is finding is that China's stock market's actually doing quite well and probably deserves more attention and more capital.
Now, a lot of people are asking the question whether or not China is cheap or expensive relative to its peers. The problem is there aren't that many peers to compare it to, right?
Well, I think that's right. It's a little bit hard to decide which peers to look at. So in our study, we look at China's performance from 1995 to 2012. And you're right, China's stock market's had a lot of volatility. But what we find is that the average performance has been very good. So we're finding an average return of 15 to 17% compared with other large economies, stock markets in other large economies like the U.S., Europe, and Japan. That's very good. So by contrast, the U.S. stock market performance over that same period was only 9.5%. And if you look at China's performance on a risk-adjusted basis, taking into account its very low correlation with other markets, because it's a closed market, its risk-adjusted performance looks even better.
Explain to our audience around the world, when you say closed market, I mean, there are the A shares, there's the B shares, and there's the Hong Kong H shares, and I guess in a more simple way, some shares are available to foreigners and some are not. But how does that ultimately impact whether or not a foreigner wants to or should invest in a market like that? China has A shares, which domestic investors can invest in, and then it's got H shares, which investors in Hong Kong can invest in, for example. Our study focuses on the A shares, and there's a little window through which foreign investors can access China's markets called the Qualified Foreign Institutional Investor Program. But that's a very narrow window. It only allows up to 200 billion, and only about half of that's been taken down. First of all, there's a lengthy approval process to get the money in, and then there's even a more lengthy process to get the money back out, and you have to get it back out in installments. For the most part, China's A shares are stocks on Chinese companies traded by Chinese investors, and it's really a segmented market that's separated off from the global stock markets, the other stock markets around the world, which themselves tend to be much more integrated with each other and highly correlated with each other. If there's one thing that you could advise on the officials there who are handling the stock market, making regulations, what one change would you recommend they do for the stock market that would ultimately be positive in the long term?
Well, what we're finding is that, though the recent past has seen China's stock market slow to recover, over the whole period, China's stocks have performed very well. But the other side of the coin of that high performance is that's a high cost of capital for China's firms. And so that can make it hard for China's firms to get access to financing, particularly the small and medium enterprises, which are really the growth engines of China. So first of all, it's important to keep that IPO channel open. So we're very glad to see the China stock market reopen to IPOs this January after a year of closure. But the other point is that we're finding that China's stock market would offer very high returns to foreign investors if they could get access to them. And so that again, is high cost of capital. So if China could open up its stock market to foreign investors, what you might expect to see, and if foreign investors weren't too worried about the political risk of getting the money back out, then what you might expect to see is foreign capital flowing in, driving stock prices up, lowering China's equity cost of capital,
and fueling investment and economic growth.